Well, welcome everyone to this session of Solid Finances. Quick thank you to our sponsors, Montana State University Extension and NDSU Extension, for providing some time and for us to do these webinars for you. Just a reminder where our website resources are located. You can see our link there right on the screen. There is actually no upcoming schedule right now. This is the final session for the 2020-2021 kind of season. And then also, if you missed any of the sessions that have been recorded in our resources as well. During today's webinar, if you have questions or comments, if you would like to use either the chat function, which is located on the right side of your screen, or you can also use the Q&A box as well to send those to myself or Joel. Today, Joel Schumacher from MSU Extension will be talking to you all about preparing to meet with a financial or investment advisor.
All right, well, thank you, Carrie, and thanks everyone for joining us. Like Carrie said, this is our final session in this sort of academic year worth of sessions. So this topic specifically today came from a request from some past participants in the session about, what do they need to bring when they're coming to talk to their investment advisor? How do they prepare? And it builds a little bit on a couple other sessions that we've done in the past. And I'll try to point out some of those overlaps in places where that's true. So the first thing, when meeting with an investment advisor is, what kind of goal are you walking in with? Is this a retirement planning meeting? Do you have some big purchase down the road, whether that's maybe a second home or a lake cabin or, a RV or something that you're planning for and you're working towards a specific goal like that. Maybe you're planning for educational expenses for your kids or grandkids. Maybe you've got something else. Maybe it's buying a business, or I know I've got a colleague that made a pretty significant ranch purchase once they retired. So that was something they had planned for, was not only sort of a stream of income in retirement, but also a significant purchase, timing at the same time with kind of leaving their employment and losing income there. So that was something that was specific to their situation. And then finally, many people will go in with multiple different goals and be working with an advisor kind of collectively about all these goals. So maybe you're working towards retirement, but you're also working towards having $30,000 saved for your kids' college education, all of those different things. But having that expectation going in is going to, one, allow the investment advisor to hopefully meet your expectations, but then two, also for you to prepare specifically for what that expectation is, so that you can, work towards that and kind of avoid some of the side things that aren't particularly relevant to that discussion. The next thing to think about with this kind of why are you meeting is, who are we planning for? Sometimes people are going to go in and they're going to plan specifically for myself. I could certainly set up an appointment with our company retirement plan sponsor and talk specifically about my retirement income, right? And we could make a plan, choose investments, decide what the contribution level should be based on what kind of income I want, at what age. But for my personal situation, that's probably not near as relevant as thinking about me and my wife planning together. And in many cases, we're going to talk about household income as opposed to an individual's income. And it might be that there's overlap, and it's important, I would say, to incorporate both sides of that piece, especially when we're talking about picking investments. If your spouse happens to have a defined benefit plan, essentially that's like a zero investment risk situation. So it might be possible that if that's the case, the other spouse might want to have more risk in their portfolio than they would have if both, say, had a 401k style plan. So those are some important things, is to, recognize who all we're planning for. Some people specifically, if you have a family business, whether that's a farm and ranch, or maybe you're also, involving your kids' education costs. So maybe they need to be involved in at least a portion of that planning. Many times, I think you're also going to find that retirement or investment planning has an estate planning component to it. So yes, we're saving for retirement and we want this income stream, but we also do need to think about things like beneficiary planning, wills and those kind of things, about what's the best way to transfer retirement assets or other assets when you and your spouse pass away. So you may see some blending there, where we need to incorporate some other members. And anytime there's a business involved, we just need to think carefully about how to incorporate the business partners in at least a portion of the process. And whether that's a family business or a non-family business, that can really add some complexity to the meeting. But those are important things to convey to your advisor. If there are alternative goals, say you and a non-family member have a partnership to run a business, what would be the best situation if one of you, were to pass away, or how would one buy the other out in terms of creating a plan that would allow some flexibility for those kind of things. So much more complicated if we have a business involved. So the next, kind of point here is, in addition to kind of having that goal of what you're working on and who's involved, but what do you want to leave that meeting with? Some people are going to want to go to the meeting, especially say if it's a retirement planning and you're looking at your investments, to walk away with, here's the amount I need to contribute to the plan, and here's the investments I need to reallocate to or start investing in. And they want to walk away with essentially the plan completed and those two action items either done, or we know that I need to the next day contact the payroll department or make some changes to the portfolio. So many people are going to go in with that expectation. There's also other times when it's going to be part of a series of meetings. So you might go in and you might present some information to the advisor and share some of your goals and talk about some things. They may then want to ask you for some additional information, specifically if you haven't brought kind of some things with you. But also you may come up with some issues that you may need to consider, about some pros and cons of, if we choose this type of option, that would limit us from doing these type of things. And you may want to, think for a few days or discuss among you and your spouse about, what the advantages and disadvantages of some of those kind of things would be. At which point, a series of meetings might be the better expectation.
Joel, we've had a kind of a question comment come in. This might be a good time. So their only financial advisor happens to be who runs their retirement plan at their work. And they don't think they can really talk to them about a comprehensive plan like investing in retirement and other investments. What kind of suggestions would you have for somebody in that situation?
Yeah, that's a really good question, a common question too. So I think a lot of us, especially younger folks that are, first getting into the workforce, and as we move maybe into the middle of our career, we don't have an investment advisor, but you're assigned sort of from your 401k plan, or, if you're here at MSU, it might be your TIA-CREF plan, that you can call in and get investment advice and some help in planning. But the services may not be as comprehensive as, to cover things like maybe saving for your kids' college education or some of those kind of things. So one is, and we'll talk a little more about this, but what is that relationship between you and the advisor you're calling? So oftentimes those advisors for your 401k plan or 403b are free to you. So that's certainly great. I know when I, visited with mine, they certainly were willing to take some information about my Social Security retirement to incorporate that into the plan. But they weren't probably willing to talk to me about, 529 plans for college savings as well. So that gives you kind of a second option here. So where else can we find investment advisors? So there's a couple different kind of common ways I would say that we can do it is, one, if you are going to save towards another goal outside of your 401k plan, whether that's an IRA, just a general investment account, a 529 plan, the investment company that you choose to work with may also provide some of those planning services to their clientele. So if you open up an IRA, they might be willing to talk to you, not just about their IRA, but also about your broader retirement savings goals. So that might be one way to gain access to some additional advice. Oftentimes those investment advisors, specifically at companies that you can choose, so you often can't choose your 401k provider, but you can choose where to open an IRA or a 529 plan or just a generic investment advice. So sometimes offering services beyond the product that that you came to them for. So you opened an IRA, they're probably willing to talk to you about things like 529 plans because they would like your business in that area as well. So anytime you're working with another company like that, they're trying to earn your business. So I wouldn't be surprised if many of them are going to offer some broader advisory services in a little more comprehensive way. Now, another option, which can be a little bit hard to find, but some investment planners do provide services of planning just by the hour. So they don't host any of your accounts. They're not a company you've got an ongoing relationship with. This is someone you just hire to say, please help me make a comprehensive plan or a retirement plan, with no sales pitch other than you're paying them, so many dollars per hour to meet with them, or so many dollars to have a plan created. So that could be another way if you need additional services from what you're currently receiving as well. So some great questions there as well. So there's one more question that came in, and it's been, we did a whole session on this, but it's been a while ago. But it's, how do you pick an investment advisor? And that can be a challenge for a couple different reasons. So one thing with investment advisors is each company kind of has a different, I would say, way of doing business and different advantages and disadvantages to some of those. Some specifically target higher income individuals, like you have to have so many dollars of assets before you can be a client of theirs. There's others that target, lower income investors, or not lower income, but lower investment asset amounts. So maybe you don't have to have a minimum amount as well. The other thing is there's a lot of personal connection in these. Do you personally get along well with this advisor? Do you communicate well between the two of you? Do you prefer face-to-face meetings where they prefer to interact via phone? Or maybe a company provides services via an 800 number. Those are all kind of personal preferences, but certainly things to weigh out. And there's not a simple, this method is always better, especially because so much of that is personal choice. But your asset value sometimes does open or close doors to you in terms of which advisors that are willing to work with you there. So some good questions. We did spend kind of a whole session on that. Different licenses, which we'll talk about as well. And we'll get to a few of these a little further on. So I might circle back to this question in our kind of conclusion today as well. Another thing that I would, like to point out is just this different type of investment advisor. And again, this is building on kind of the last two questions there is, some advisors are going to be able to provide kind of education or some planning services for you. And oftentimes this is what your 401k provider is going to provide. They're going to educate you and say, this is kind of the risk level of this investment that's available to you. And you may want to have, 40% in this type of investment and 20% in this. But they're not actually going to make the transaction for you or make a specific recommendation, but rather they're just going to kind of give you advice and say, based on your situation, this is some things that I would consider, but then it's kind of up to you to take the action item. This is certainly true with some of those hourly fee-based ones, especially if, they're giving you advice on how to, invest your 401k plan, but they don't work for your 401k provider. You're the one that's going to have to, actually make the investment decisions. So that's kind of one realm of, advising or educational services. There's another realm of this where you're talking to someone that can actually provide specific, maybe mutual fund or stock investment recommendations, and they can actually make those transactions for you. So you can sit down, have this discussion, and they say, I think this is a good, mutual fund for you, and this bond fund is great in this particular company, and here's how I think we should go forward. And you say, yep, I agree with that. And then they can actually make those trades happen in your account for you. Typically, those type of folks will hold a brokerage license, which allows them to sell securities. So stocks, bonds, things like that, mutual funds, or they may hold an insurance license as well. Some of the products that are going to be offered to you are actually going to be a type of variable annuity, which oftentimes operates much like a mutual fund or some other more traditional investments. So the licensing, though, to make those transactions is typically a brokerage or an insurance license. And going into a meeting, it's good to know just what kind of services that your particular provider is able to offer to you, and make sure that's a fit with what you're looking for. If you're looking for somebody to just take care of it and do it and make those transactions, you definitely need to be in kind of this second half here where someone can make those transactions. If you're comfortable saying, okay, after we created this plan and I got this nice, 10-page glossy plan, I'm willing to now go log into my accounts and make various trades to make that happen, or talk to my payroll office and make the changes to save more or whatever it might be, the first side would probably be just fine. Now, I think we've already hinted at this a little bit. Do I have an advisor? Because many folks are going to say no. And I think for many years, especially folks in their 20s and 30s, it's probably somewhat rare for them to specifically have an advisor that they've got a relationship with. So oftentimes that first advisor is going to be those free educational services that are provided to you from your employer defined contribution plan. Now, if you've got a defined benefit plan, we're not going to see those kind of services, because the reason they're providing those planning services is because they have a fiduciary responsibility to help the plan participants make a investment choice. So that's why they're going to provide those educational services. In a defined benefit plan, the employee participating doesn't make any of those choices, so there's not a role for the plan sponsor to provide those kind of planning services along the way until somebody gets a little closer to retirement. And then they may have some educational programs about selecting different options of taking their retirement benefit. And then, the next thing, I think I hinted at this a little bit earlier, there are certainly many local companies that you can walk into their office, meet with a specific person, they're assigned to your account, and they can handle these type of businesses. Now, there's also been a trend over the last 20 years, probably 30 years now, of moving towards centrally based investment advising. So whether you're calling an 800 number or reaching out on a website, even having now a lot of computer, I don't know if I want to call it artificial intelligence, but some computer generated planning services playing a bigger role as well. And again, so when you're looking for an investment advisor or a company to open a plan with, finding out what type of services they provide and what format that is can be an important kind of shopping feature in terms of, what kind of services you're looking for and what does ABC investment company offer versus, XYZ mutual fund company. That can be a good comparison point in terms of how to select one that's right for you. Now, I labeled this next slide here alphabet soup, because nearly every investment advisor that you deal with is going to have some type of license, certification, agent status, broker status. I didn't look very hard to pull these up, but even if you're in the industry, keeping track of what each of these are and what the differences between them mean can be a challenge. And it's not that any is necessarily bad, but they can mean different things. Certified financial planner is certainly a common one. It's much more intensive to obtain than the accredited financial counseling certificate, just in terms of the amount of study time and things that go into it. Some of these certifications are a pass it once and you're done. So, let's say you're talking to a 60-year-old advisor, maybe when they were 30, they took a test, passed it, got their certification, and they've not had to do any education since. Most of them, though, have some kind of continuing education requirements that help those folks stay on top of changes in the industry and stay current with their information. So if you're considering brokers, one, you might ask, what licenses or certifications do you hold? And then go ahead and do, an internet search and find out what is a AFC. What are the standards for somebody to obtain that? How is that different than the CFP versus a insurance agent that holds those licenses, or someone that holds brokerage licenses like a Series 6 as well. And these are some good things to talk about with if you're shopping for an investment advisor, of just, what kind of certifications do they have? Why did they get those particular ones? What kind of services does it allow them to provide? Now, there are a couple things that you can do to research some of these things too. Specifically, investment brokers. They are registered and licensed, and you can look up a particular company or a person by name, and brokercheck.finra.org is the place where you can do that. And it'll list on there, let's say it was for myself, when I had some active brokerage licenses early in my career, you could look up and it would say that, in October of the year 2000, Joel earned this particular license and it was housed under this company, because you need a sponsoring agency. And it'll say how long that, person has had that license, if it's still active. Also, if it's had any complaints against that, so somebody claimed that, I didn't follow through on a trade as intended, and there was an investigation, and it'll say that, there was this report, and it'll say, here's how that particular item, was resolved. You can also look that up in terms of an office or a company basis. So, maybe you're considering, setting up an appointment with Jane at ABC Financial Services Company down on Main Street. You can look up ABC Financial Services and find all the brokers that work for them and see if the company's had any complaints against them and resolutions as well. Insurance agents are handled somewhat the same. They're not handled at brokercheck.org. And this varies by state. In Montana, that's actually the state auditor's office. Is the licensing agency here, and they would track kind of similar information about an agent's license status and if they've had any claims against them. So that's how it's handled in Montana. In some other states, the name of the office might be different, but every state does have some type of commissioner of insurance that handles those type of activities. So just good to know what the alphabet soup means when you're shopping around and what they can provide. All right, so now, I think one of the more important things, I guess, today is, what do you bring when you're going to talk to an advisor? So the first thing I would just recommend first is ask your advisor or check out their website and see if they've got a list already. If they've got a list and they know what documents they want, that might fit in nicely with whatever software program they're using, or if they've got kind of a formula of handling things, then you can go right down their list and check that off and bring in those required documents. Now, if they don't have a list, or you're just preparing in advance, and maybe at the first meeting you're going to ask for the list, you can prepare a lot of things yourself, because it's going to be pretty standard, and that's what we'll talk about here for the next few minutes. So first of all, don't be surprised if they want to know things about your family, yourself, so your age, your family members, how old your family members are, specifically your spouse. Do you have dependents that you're still financially supporting? What's your employment situation look like? Do you have stable employment? Does it vary based on commissions or seasonal? Has it varied much over year? Is it stable? Is this long-term employment, or do you do somewhat short-term contracts with different companies where your income could fluctuate more? And again, if you've got business ownership, they're going to want to know that as well. So don't be surprised if they probe a little about things you think might not be relevant, because they're all trying to get a picture of your overall kind of financial situation. So the next thing is going to be some copies of your financial documents. Now, one thing I'll note here, like with retirement plan statements, if you are meeting with, let's say at MSU here, TIA Craft, you don't need to bring in your last TIA Craft statement to talk to TIA Craft. They will have access to that information already. But specifically, if you've got an IRA account that is not part of that, or if you're talking to your IRA advisor and you want them to know what's in your TIA Craft account or whatever other account you've got, bring in that statement so that you can sit down and look at it and say, well, you've got 40% stocks and 20% international fund, and not be guessing at, hey, I think the other one is set up like this. You can actually kind of go down together and work through what those things are. A copy of your Social Security statement can be helpful. Oftentimes, when doing a retirement planning, they may even ask, do you want to include Social Security in your estimates or not? If you have the statement, it makes it a little bit easier, because your Social Security benefits are based on your actual work history. So you can generically estimate them, but it can be more accurate if you actually bring in your last statement. And some of you may also remember from some previous sessions, the Social Security Administration doesn't mail statements to everyone every year anymore like they used to. Until you get a little bit older, they're not going to mail you paper copies, but you can go to the Social Security Administration's website and print out your particular statement by creating an account there, and bring in that same information about your work history and what it'll actually project out what your benefits would be at age 62, your normal retirement age, which for most folks is somewhere between 66 and 67, and also if you waited until age 70 to claim those benefits. And then kind of collectively, the rest of these statements here is just any kind of major investment accounts that you've got, savings accounts, CDs, 529 plans, if you've got health savings accounts. And with things like the checking account, we're not particularly concerned if you've got 1,000 or 4,000 in your account. We're talking about retirement planning. But if it is a major asset for you, then they're going to need to know kind of collectively, oh yeah, well, there is this other chunk of assets that you've got set aside, or you've already got an emergency savings account. So we don't have to worry about that investment choice when we're, making broader investment decisions as well. So having copies of those in a folder when you walk in can be very helpful. Now, on the other side of this, they're going to want to get a picture, specifically if we're doing a comprehensive plan, to know what else is out there. Maybe you do have $300,000 in your 401k account, but maybe you also have a $500,000 home with a $490,000 mortgage. So there's some risk components and some understanding of your overall picture that comes with recognizing what your debt looks like as well, and also what your income needs are going to be. So if you purchased a home when you were 40 on a 20-year mortgage and you hope to retire when you're 62, we don't need to budget for the income to support making a mortgage payment during retirement, because your mortgage will be paid off before you get to retirement. Now, if somebody was age 55 and took out a 30-year mortgage, your income needs in retirement are going to need to cover whatever those debt payments are post-retirement. So that's just one of the reasons that it's good to know collectively what the debt statements are. So copies of that, and you don't necessarily need to bring a statement, but we need to know, the balance, the interest rate, and how many payments are remaining are kind of the key components, and what the payment amount is each month. It can also be helpful at times just to recognize what your other significant assets are. So coming in and saying you have a mortgage for $400,000 is fine. Recognizing that you have a $600,000 home that goes with that mortgage can help your advisor to understand your kind of overall picture and do a little bit of planning in that sense as well. Some other documents that are important here is, your most recent tax return. The reason we want to know this here is really talking about marginal tax rates. So in the US, the way our tax system works, we all pay sort of a low amount on the first dollars that we earn, and the next few dollars we earn is a higher tax rate, and the last dollars we earn, it's a higher tax rate yet. Those are called marginal tax rates as we build on them, and they tend to be progressive in the sense that they get higher as the higher income limit goes up. But if you're thinking about contributing more to a 401k or an IRA, or even something like a flex plan, your tax savings are based a lot on what your income level is. So having an understanding of what household income is something that can help your advisor, kind of fine tune their recommendations for you and create a plan that might be different for somebody that's in a 12% tax bracket versus a 22% tax bracket. You may have a little bit different nuances in terms of creating that plan. A recent pay stub can be helpful. One, it proves your income, but also it can help understand what employee benefits and your current 401k amount are. A lot of people are not necessarily passionate about knowing exactly how many dollars go into their 401k account each month. So having a pay stub there can just help remove all the uncertainty, and you're not guessing at anything. You can quickly do some math with your advisor if there's something that you need to identify and resolve. Employee benefits can be important as well. So, I mean, knowing your total salary is one thing, but understanding that your employer is providing health insurance. So if you retire, that's now something you're going to have to pick up, at least until you reach Medicare age. But also, if you can have information about what your employer matching formula is for retirement plans. If your company matches dollar for dollar the first 3%, I'm sure your investment advisor is going to encourage you to put in at least 3%. If they say we match 50% of all your contributions up to 10%, your retirement advisor is probably going to recognize that, there could be some real incentive to putting 10% of your salary into there, as opposed to maybe doing some of the savings through an IRA or another vehicle to take advantage of that. So if you can bring that information in, again, you can just help make a little more educated decision about what the choice might be best for you. But not having that information kind of means you're guessing a little bit. So the more accurate information you can have, the more accurate the plan that you're going to create can be. And then things like a flex plan information can just be another way to get some reduced taxes by participating in those programs for medical expenses or daycare expenses that you've got. So again, if you're doing a comprehensive plan, just another tool that you can have in your toolkit if you're incorporating facts about those decisions as well. And then life insurance policies are often part of retirement planning as well, specifically if we're talking about a couple, where what if one couple were to pass away relatively young? Understanding what the life insurance components are for the surviving spouse can be important as well. And for many employers, they provide at least some level of life insurance to their employees. So bringing that information in, whether it's privately purchased or purchased through your place of employment, can be helpful. And then kind of another component here is many of us are going to create an investment plan more than once in our life. And oftentimes those later investment plans are going to be adjustments, tweaks, revisions to the prior plan. So, if you've created investment goals in the past, sat down with your spouse, identified some things you want to do, dates you want to retire, whatever those kind of things are, and written them down, bringing in your old copy or starting from your old copy can be a very helpful tool, both in terms of time and in terms of just making sure you don't miss anything as well. Same with your investment plans. If you've sat down and crunched through this 5 years ago and said, we had these goals and here's what we were working towards, and now you can sit down and say, well, our goals have changed a little, but we still like these things. Here was the investment plan we had. That can be a good starting point for your discussion with your advisor in terms of what do we need to adjust and what do we already have prepared and ready to go. So if you've got copies of those, bringing them in can save a little bit of time for everyone. Now, I wanted to kind of share a couple of examples of some different situations that I think highlight what happens when we don't bring this information in. So one that I kind of mentioned along the way, and I didn't make an example on this, but is that we're guessing at what some piece of information is when we're making our plan. So whether that's, we don't know exactly what our employer matching plan is, we just know that when we put in $300, they put in 150. So we're guessing a little bit is one of the challenges with not bringing in the actual documentation. And anytime we're guessing or have assumptions that aren't quite right, the end result isn't going to be quite as good as if we had factual information going into that. But a second component here, and again, I'll just show it in terms of an example here. We got John that wants to discuss retirement planning with an investment advisor. He's 35 years old. He's married, no kids, does not own a home, earns $50,000 a year. He's putting 8% into his 401k plan, and his company's putting in a 50% matching contribution. He's already saved $125,000. And he's got this mix of 60% stocks, 20% bonds, and 20% real estate in that current portfolio. So that's just kind of our background information about John here. But then let's say John's wife earns $130,000. She contributes the maximum to her 401k account each year. She's got over $300,000 in her 401k account. And then Lisa owns a home, a lake house, and 4 rental properties in her name. So combining that with what we knew about John on the previous slide, if he hadn't chosen to bring in the information about his wife's situation, the advisor probably would have made quite different recommendations. So knowing this information will also help the advisor make a plan that really works better for the family situation, recognizing those two things together. Now, alternatively, what if John's wife worked part-time, stayed at home, did not participate in a retirement plan at her place of work? Again, this is the type of information that your advisor would like to know, because he would probably have very different recommendations for John based on these two stories of what John's spouse earned and what the matching situation was and what the other resources are. So again, it's just good to make sure that you've shared that information so that your advisor can make a recommendation to you based on, kind of all available information. Now, different example. Let's kind of shift gears a little. We'll talk about Bill here for a second. And he's age 50. He's got the following, a couple accounts here. We got a 401k with 60% stocks and 40% bonds. But he also has a deferred annuity that has a guaranteed 4% rate of return. And he's got $380,000 in that account. So now he's talking to his IRA advisor. How should he invest this $60,000? Well, if he just talked to this IRA advisor and that's the only information the IRA advisor had is that he had $60,000 towards his retirement, he might come up with a mix that looks, something like 60-40 as Bill's starting to get a little bit older here at age 50. He's not at retirement age, but he's, kind of getting closer to that number. He's not a 30-year-old anymore. So he might come up with something that's relatively balanced along those lines, also recognizing that Bill doesn't have a great deal of other retirement assets. Now, if we told him about the $200,000 and added that piece of information in, his IRA advisor might say, hey, we got 60-40 in stocks and you've got a little more assets than I had thought. We could probably take a little bit more risk maybe than I otherwise might have thought. But then finally, this deferred annuity piece is really where the bulk of his assets are, where he's been paying money in, and when he retires, essentially he'll get this stream of payments for the remainder of his life. And oftentimes these are sold with a guaranteed rate of return built into them. But we can kind of think about that in terms of a risk load of being very low risk. So if we incorporate that piece into his decision-making process, we see that really his largest asset is a fixed rate, low risk investment. So if you give that information to the IRA advisor who's helping you, he's probably much more likely to tell you that, you need a higher percentage of riskier stocks in this portfolio to offset this very, very low risk asset that you've got in the variable annuity. So again, those are the kind of things where limited information can really challenge your investment advisor. So that's where you want to make sure that they've got the best information they've got to help you make that that plan come together. So there are times maybe you don't want to share every detail of some of these other plans, but even being able to, bring in your 401k statement, look at it and say, okay, I'm 20% in international stocks and 30% in small cap stocks. And even if you're able to write down that information to provide it to your other investment advisor, can really help them to create that plan that's going to reflect the best information that's available to everyone. So with that, I think I've come to my question slide. Is a little bit shorter topic today than we've had some others. I do know we've had at least one question come in here. And the question is, what is MSU's retirement matching formula? Well, let me start with a couple things. First of all, MSU has a whole variety of different retirement plans depending on how you were hired, what your position is. Most of our classified staff are in the PERS system, which is a defined benefit system. TIA-CREF is a defined contribution plan and probably the most common one. And in this, we actually have mandatory deferrals of roughly 7% for the employee and just slightly less than 6% is the company contribution. So I think that's the main one. We do have PERS defined contribution plan active on the campus as well, and I don't know that one off the top of my head. So with that, I'm going to pause for a minute. Carrie, are there any other questions that have come in?
There are not any other questions that have come in. We've done kind of disperse them throughout the presentation today, which is good because then we can answer as we're talking about that time. Oh, here we go. Actually, as we're talking, can you please talk about the difference between a defined benefit plan and a defined contribution plan?
I can, yeah. So there's a lot of different lingo for retirement plans. So let me try to clarify a couple things. So first of all, let's talk about defined benefit plans. So defined benefit plans, you may also know as the word a pension plan. In many states, you see things like public employees, teachers' retirement plans. Some union plans are also this way. And essentially, what happens with a defined benefit plan is, in most cases, the employee and the employer contribute every month the employee works over the course of their career there. And then when it comes time for an employee to retire, they take a look at the employee's average salary, typically over the final 3 years. And then the number of years they work there, say 20, and it's oftentimes measured in months, times a retirement factor, which is somewhere like usually between 1.5% and 2%. You multiply those together, and that's going to be the employee's benefit. So the benefit from the plan is defined by that formula. So that's where the term defined benefit comes from. In a defined benefit, all the assets are pooled together. So the employee makes no investment in choices while they're working there. The company hires someone to manage that group of assets together. So there's no choices for the employee to make along the way other than usually it's a mandatory fixed amount that you contribute. And then when you retire, you'll receive this fixed benefit. So that's a pension or a defined benefit plan. Now, defined contribution plans, there's a whole lot more names that you may know them by. 401k, profit sharing, 403b plan, 457, a SEP or a simple plan would also qualify there. Money purchase pension plans, KEO plans, those are all different types of, or at least names for retirement plans. And in this case, the employee and oftentimes the employer, although not always, contribute to a plan each pay period. And then the money goes to an account, housed under a larger umbrella, but specifically has an employee's name on it. So it would say, this is Joel Schumacher's, ING financial account. And I would likely get to make investment choices from a menu that the employer provided to me. So I need to make those investment choices along the way. And those would be things that the company would oftentimes provide me some educational services to help me make that menu. So that's what a defined contribution plan is. Matching, profit sharing, money purchase pension formulas can all be kind of a part of those. But lots of different terminology, but defined contribution is kind of the broad term to cover all of those plans.
Great, thank you. Another question. This person has a question about when and how much money to move out of a traditional IRA to a Roth prior to retirement. Are there any tools or resources to reduce taxes after retirement? And
Yeah,
this might
so
be ask your retirement advisor, but go ahead.
well, yeah, but taxes are going to be an important component of a lot of good investment plans. So, as you know, with a traditional IRA, you essentially defer paying taxes on that money until you withdraw it during retirement. On a Roth IRA, you essentially pay the taxes before you put it in, so it comes out in retirement on a tax-free basis. So, do you want to pay your taxes now or later? Is kind of the choice between a traditional and a Roth. And you may know something about your current tax rate currently. So you can make that decision that, if I were to put money into a Roth and take that, essentially pay the taxes now, this is the rate I would pay. If you put it in a traditional, you know what your tax savings would be today. It's less clear what your retirement tax bracket would be after retirement, whether it's because we don't know exactly what our income level will be, or we don't know what the tax policy environment will be during those retirement years. So there's a bit of an unknown. You can convert money from a traditional to a Roth. And you can probably sit down with your accountant if you'd like, or your retirement advisor might be able to provide some tax help as well, and at least figure out what the consequences or the tax consequences would be of converting that this year based on your current income tax bracket. But then you'll have to come up with some kind of estimate of what the alternative would have been. So if I'm 50 years old, I can convert $10,000 this year for this tax cost, but how much taxes am I saving in the year, when I'm 66 years old, when I draw the money tax free? And you'll just have to make some assumptions about that. So some companies have some software tools that you can put some assumption in, and it can help you with that decision. Some of your investment advisors might be able to do that as well. But there is always going to be this uncertainty about your future income and the future tax policy environment, both federally and state income tax wise as well.
Yeah. So you had said that they can they can move money from a traditional to a Roth. Can they do that after retirement? Is what somebody's asking.
I would certainly think so. IRAs are not tied to employment in any way. So your employment status really shouldn't have any impact on your ability to utilize those accounts. You do have to have earned income to make a contribution, and you have to be over, I think, age 18. But beyond that, I don't see why employment would be a specific restriction to doing that.
Thanks. So I also did in the chat, if there is the link to the evaluation for today's session. And again, we want to thank you for joining us and being active participants in our webinar series. Joel, anything else that you wanted to mention?
Just one kind of closing comment. After the end of today's session, it will take you to that short evaluation. In the next week or two, look for an email from me, and we're going to ask you to evaluate the entire year and to give us some ideas for future years planning. So if you've got some session topics you'd like to see covered, some feedback that you'd like to send us, we will be sending that a week or two down the road to take a look at the whole series and see if we should make any changes for the upcoming year. All right, not seeing any other questions. Thank you, Carrie, for hosting, and thanks everyone for joining us. And we hope that you will join us again in the fall when the series restarts.